In this video, we will cover some important topics related to self-employment in Canada. Are you self-employed or thinking of becoming self-employed? Then this video is for you because taxes work a bit differently when you're your own boss. First of all, we need to understand what is self-employment, what will get filed, what you can write off, and how you can avoid CRA surprises. But I'll break it down step by step. My name is Hussein. I'm a CPA here in Canada, and I help small business owners stay on top of their finances. Let's get started with the basics. What does self-employment mean? If you're not getting a T4 from your employer, then you're probably self-employed. For example, that could include consultants, freelancers, professionals, and anyone selling products or services in Canada. Basically, if you work for yourself and get paid directly, then you are running a business. Now, as a self-employed individual, you can run a business under a corporation or a sole proprietorship. But generally, when we talk about self-employed, we are referring to sole proprietorship because that's where most people start. What forms do you need to file? As a sole proprietorship, you and your business are the same. There's no separate tax return like there is for the corporation. You can still register a business name for your branding, and you can get an HST number like any other business. But at the end of the day, everything gets filed on your personal tax return. There's a special form called T2125, Statement of Business Activities. That's where you would list your business income and expenses, all as part of your regular tax return. What taxes do you have to pay? You would take your income and deduct your personal expenses to get to your profit. As a self-employed person, you would pay federal and provincial income tax on your profits, not on your gross income. But that's not all. You also pay into the Canada Pension Plan or the CPP. Now, since you don't have an employer to split the cost with, you would need to contribute to the CPP as an employer and an employee. This can add up, so it's really important to plan for it and manage your cash flow. Now, what about EI or employment insurance? You don't have to pay into that unless you register for EI Special Benefits Program. This program can be useful to you. It gives access to things like maternity, parental, and sick leave. It's completely optional, so you don't have to register for it. But remember, if you register for it, then you have to pay into the program for the rest of your life. What deadlines should you know about? This is where people often get caught off guard because it can be a little bit complicated. If you're self-employed, your filing deadline is June 15th. But just like every other individual, the payment deadline is still April 30th. That's right, even if you file in June, you still have to make the payment by April 30th to avoid any interest. And if you owe more than $3,000, then CRA will ask you to pay on a quarterly basis going forward. Now, what expenses can you deduct? The rule of thumb for every business is that if you spend money in order to generate revenue, then that amount can be deducted. Okay, so here's the good news. You only pay tax on your net income, not your total revenue. That means you can deduct your expenses and that reduces your tax bill. The rule of thumb for every business is that anytime you have to spend money in order to generate business revenue, then you are able to deduct that expense. But I will go through some common expenses that usually are missed. Common expenses include home office, internet, business phone, vehicle expenses for the amount that you use for your business, and meals for which you paid while meeting your clients. Depending on the business, you can write off software, tools, and yes, even your accounting fee. Just remember, expenses must be reasonable and they should directly be related to your business. How do you track income and expenses? This is where a lot of people struggle, but it doesn't have to be that way. If you have a small operation, I would recommend using a good Excel template that you can put your transactions in and calculate on an annual basis. And if you have a bigger business, you do want to use a software, something like QuickBooks or Wave. And remember to save your receipts, and that could be electronically or physical receipts saved in, let's say, a Ziploc or a folder. How much should you save or keep aside for taxes? Now, if you're registered for HST, remember that you are keeping the HST or GST in trust for the government. And so that should be kept aside and paid back to the government. This would be net of the deductions that you're allowed to deduct, which are called input tax credits. A good rule of thumb is to set aside 25 to 30% for taxes. And if you're making over $100,000, then you probably want to set aside between 35 to 45%. If you struggle to keep money aside for taxes, I would recommend to create a separate bank account. It could be, let's say, a high interest savings account where you get some interest as well. And from there, at the end of the year, you could make the payment that is owed beyond the quarterly installments that you might have to pay. Can you pay yourself a salary? Now, this one confuses a lot of people. As a self-employed individual, you don't pay yourself a salary. All of the money that you earn and the profits are completely yours. So there's no payroll or there are no T4s unless you hire an employee. You just withdraw the money from the bank account when you need it or pay your credit cards. That's it. No special process needed. Now remember, the taxes are calculated on your net profit. So it has nothing to do with how much money you take out of the account. It's purely based on how much income you generated and the expenses that you subtracted from the business and the net profit. This is different to corporations where you can pay yourself a salary or a dividend, and that could be part of the tax planning, but that's a different topic altogether. So we will cover that in a different video. Now let's talk about some tax planning. Can you split income with your spouse? Yes, this can be done, but it has to be done properly. If your spouse helps in the business, even if it's on a part-time basis, you can pay them a reasonable wage. Then this amount becomes a business expense on your personal taxes. Your spouse will pay taxes on it, usually at a lower rate. Now, this whole game is about the rate, so if your spouse is in a higher tax bracket, then this is probably not a good idea. The pay should reflect the actual work that your spouse did and something similar to what you would have paid if you hired someone from the outside. To make it audit proof, you'll want to create an employment contract, also keep records, timesheets, and create a job description that matches what your spouse is doing. This will help back it up in case CRA ever asks questions. If this is done properly and there's a large difference between the tax brackets for yourself and your spouse, then it can really save you thousands of dollars. So there you have it. Self-employment gives you freedom, but it comes with a lot of responsibility.